Okay. Um, Good evening, guys, and welcome to tonight's session on understanding the market business model. And I think I should start from, it's been a while. It's been a while, yeah. I think the last time we had a session was about 2 months ago, if I'm not mistaken, and that's because I had to attend to some other things. Okay, but I had to attend to some other things. As much as we are traders, we also have life away from the charts. And I've seen majority of you, especially those of you following me on Twitter, majority of you tag me and keep on reminding me about MBM 025. And I must say I'm sorry for keeping you guys waiting, but I just had to attend to one or two things. But we're good. We're good. So I'm back now, and I think you should get your lamp ready. Put more oil into that lamp. Get your notepad wherever you have kept it. Go and bring it, dust it, and pick up your pen. Because we'll be going into like I said, the last phase of understanding the market business model, and this would be the most challenging phase because you see in this phase we will try to compile everything that has been taught in the MBM so far into an understanding. That is the target. Okay. And in our last video, I remember where I was speaking about, I think I was teaching you guys continuation. Yeah. How do we know continuation? How do we see continuation? How do MBM traders follow up for price continuation? And that's where I started talking about anchor candles, started talking about, swing, inversions, and the likes. So, for the sake of, for memory's sake, I'm gonna give you guys a revision, and I'm also going to because my intention actually was that when I rewatched the previous session, I realized that I the approach to teaching it or passing that knowledge to you needs a little bit of refinement. Okay, so that's basically what I'm trying to do now. So in this session, I will just try to help us build understanding from what I've been teaching, take it one after the other, and we'll build up from there. Okay. Yeah, and before I proceed, I wouldn't do this, but so far I've received a lots of messages on my mail, to my mail, and also to my inbox on Twitter, Instagram, Telegram, all my socials. And I've seen majority of you guys messaging me, asking me questions where you are confused or maybe wherever you're stuck. And honestly, I really do wish that I can attend to these questions, but I'm unable to. I can't. I'm sorry, guys. Okay, I'm a human being. I'm a human just like you. So you say I'm even yawning now. So that should tell you that I'm a human. I cannot attend to all the whole questions that is going to be thrown my way. But what I'm going to do for you guys is, as for those of you who have questions to ask me, in the next NBM class, the next that will be NBM 026, I will pass across a message and we'll see how we can fix it, okay? So make sure you watch the next MBM 026, the next video. There you will get solution to your questions and how you can. There you will get how you can, get answers to your question. Because I understand that it's not easy to be a trader and then get introduced to a new concept and you have nobody to guide you, nobody to tell you the pros and cons, do this, don't do this, and all. So I will that's basically what I'll try to fix. Okay. But aside that, you guys have been doing very well. I've been seeing your results. Some of you have been tagging me to your results on Twitter, Instagram, and even on you know on Facebook. So thank you guys so much for the tags and all. And let the goal of every trader, like I always say, is to make money. And as long as what you know gives you money, then I don't think you need any other thing else. Okay, don't follow the bandwagon of traders um, who feel like that as long as they they find they find comfort in the mediocrity of what they know. Okay, and that knowledge is not even printing anything for them. One of the highest level of results that you can ever get is a result that gives your life comfort and the kind of result that also builds or breeds results for other people. What I'm trying to say is that you see, a tree, a tree does not bear fruit for itself. No matter how much fruit a tree bears, it's not gonna eat the fruit. It's for other organisms. Okay, so animals, human beings, microorganisms, insects, a lot of other things, a lot of other stuff, right? So the point is, um, I, as the me, Chat with Max, the founder of the market business model, I do not find joy the in the accomplishment of the results that I have. But my joy is in the fact that the results I have is enough to also help you guys generate your own results. Okay, so my plea or my admonishment to you guys, my plea to you guys is that you also share to people. Okay, try to share. I mean, this is free, so share it to your friends, share it to your families. Don't hold on to it. Okay, because at the end of the day, whatever part that is not your strength would most probably be the strength of your friend, and you guys would leverage on that and use it to make money. The point is, at the end of studying the market business model, give yourself 1 2 years, you should be able to make enough. You should have lived the poverty lifestyle. You should be living a lifestyle of a profitable trader. Your track record should be showing that you know what you're doing. Okay, so that's just it, guys. Always remember that every trader is unique in their own way, and this is one of the reasons why I keep on teaching you guys the a systemic approach to the market, okay, a logical approach to the market, so that at the end of the day, after understanding this thing, you look at the one that fits you and you start using it to make money. Okay, so if you said the goal, if the goal is to fetch water, if the goal is to fetch water, either you have a bucket or you have a pail or you have a cup, or even if it's with just your hand, the point is that you are fetching water. Okay, so if the goal is to make money in this market, if it's with inversions, if it's with anchor candle, if it's with previous candle levels, if it's with VTA or VTB, whatever it is, you just make sure it's giving you the money. That's the point. That's the point. Now, you see, trading in itself has its own talk. We're going to talk about that. Everything we've been discussing so far is purely analysis, okay? We'll still go to trading but when we get to that bridge, we will cross it, okay? So let's take things one after the other, step by step. We're not in a hurry. We're going to learn everything. I'm going to teach you everything you need to become a profitable trader, and the rest will be left with you, okay? So let's start from where we stopped. And I think in our last class, I was trying to explain to you, the concept of swings at highs and lows. And that swing high, I found that high, swing lows, I found that lows, blah, 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 blah. So, but for the sake of this class, I'm going to do a proper explanation of some things for you guys so that you can understand them, okay? You see, okay, so let's start from a blank page. Now, good. You see, we as traders, we the quality of the decisions that we make heavily depends on the kind of knowledge that we possess. So when you say a profitable trader, it is not because that person choose not to be profitable. It's just that that person does not have the information, the adequate information that can make him to become profitable. And we do not want that. You don't want that as an MBM trader. So it's very important that when you are in class, when you're watching my videos, you pay attention and you take notes. Very important, because you don't want these things to fly through your head. Some of you are listening to this thing, are hearing some of these things for the first time. Some of you, this is the first time you'll be properly understanding these things. And for some of you, this is more like a boost to your understanding, to your knowledge. Because I would not want to assume that everybody is a beginner, you understand? So wherever stage you are, the point is that it's very important that you keep record, you keep informations on your book so that you don't miss anything, okay? Remember, this is YouTube class. This is not a one-on-one mentorship where you can practically ask me question while teaching. Hope you guys get. So to help yourself better, I would advise that you write notes. You pause wherever you have to pause, you write, you pause, you write. Wherever you are confused, you rewind, just make sure you understand what is being taught. That's the goal. Now, you see, guys, the market understands only one thing. There's only one language that markets understand, and that is price. You see, when markets move from a point, let's say from this point here to this point, typically we would say this is a bullish move, right? Because price is higher than here, this level here. But the point is that at the same time, if from this same point here, price came here, we would say it is a bearish move, right? Because price is currently lower than where it is. But you see, these are reference points. The reason why we can say this is a bullish move is because we are referencing from a lower point. We are referencing from a lower point, from a lower price rather. So this is a price. This is another, sorry guys, this is not what I want to do. So what I want to do is, you see this midpoint here is a price. Let's say, then this one is another price. Then this low too is another price. So we have three prices. From here, from this midpoint to this up, we would say it's a bullish move. Why? Because we have used price as point of reference. We have used this mid price here as point of reference. That's why we can say it is bullish. Look, let's say this point here is $3 and here is $2. Of course, price is bullish because $3 is practically higher than $2. But if we look at from this same point here down to this point, let's say this is $1, right? This is $1 and this is $2. We'll say price is bearish because $1 is lower than $2. The point is, I could as well say that from $1 from here to here is actually a bullish move. The same way I can say from here to here is a bearish move. It's the same way I can say from here to here is a bullish move, right? Reason being that the reference for understanding if it's bullish or bearish is price. So if I say price move from here to here, you will tell me it's a bearish move. But if I not tell you price move from $1 to $2, you tell me it's a bullish move. The same thing from $2 to $3, you say it's a bullish move. But if I say price move from $3 to $2, you say it's a bearish move. The point is, price is what we use as reference. Okay? We use price as reference. We don't use candles or moves. I hope you guys get what I'm saying. Now, I'm going somewhere. I want to help us build an understanding of something. Now, what I'm saying in essence is that if this, what I just explained here is not understandable to you, what I'm saying is that, you see, the reason why we can call this a bullish move is because from this low here to this high here, price is bullish, right? Price is higher. So let's say here is $1, here is $10. You can see, right? Based on price. Remember, in MBM, we only use price. We don't use points or all those things. Now, please follow up. I'm trying to show you something. But inside that move, inside this, from that $1 to $10, there was this down move here. Now, you see this down move, we cannot call it a bullish move, even though the whole move was actually a bullish move, or what the support, what the retailers would call uptrend. I hope you guys get what I'm saying. So, in the face of price does not know that it is selling or if it's going up. It is based on what the footprint that price leaves that we can now say, oh, this is a swing high, this is a swing low, whatever. You see, the real footprint should be following in this market is the footprint of price. And we're going to go to footprint. I think we already spoke about order flow. We'll still talk more about order flow, and when we get to footprint, we'll talk about them. How you can see the way the market moves. The idea is that, you see, price, let me say it again. When price, we traders, for us to know if price is bullish, we have to reference from a particular point in time or a particular price in time. So let's say at this point is $1, at this point here is $5. So for us to know if this $5 is bullish or bearish, you must look at if this whole move, if it is lower. You see, funny thing is that instead of going up, it might actually just come down. I hope you guys get what I'm saying. So now, in the eyes of price does not know if it is bullish or bearish. Price just moves. And price moves based on liquidity, volume, volatility, okay? Based on what I've taught you guys in previous classes. Liquidity, volatility, and volume. Those are the things that make price gyrate. Now, can you predict where price wants to go next? No, it's not possible. Nobody knows the future. See, except if you can know the future, then you should not predict. MBM traders, we don't predict, we follow. That's why we make money. We only follow. We don't predict. We don't try to see. We have no business with what is going to happen in the next. If you are a day, if you are a day trader, you have no business with what's going to happen for the whole of next month or 3 months or the year. If you're a monthly trader, you have no business with what's happening for the year. The point is you follow price. That is the reason why we are flexible. MBM traders are flexible. So once price is bullish, they follow, And then once price shows sign that it's going to turn bullish and bearish, they also follow. Now, the idea in an uptrend or a downtrend, as retailers would call it, I just wanted to show you guys something. You see, just to buttress the point that price is neutral. Yeah, that's the word, neutral. Price is neutral. Price does not know those things you are calling uptrend. Price does not know that it is going up. Oh. Price is just moving. And those things you call downtrend, price does not know if it is a downtrend. Price just moves. Now, the interesting thing about price, and this is one of the things that amaze me, right, is that you see, let's start from an uptrend. Trying to help you build understanding for something. Now, this is an uptrend, and let's do a downtrend. Now, this is a downtrend, right? Now, you see, the same thing that makes up an uptrend is the same thing that makes a downtrend. No difference. There is no addition, there is no subtraction. Okay? The same thing that makes price to go up. Okay? The same thing that makes an uptrend, the same component, the same component that makes a downtrend. But the reason, now that is it. So MBM traders, we don't trade patterns. And this is why I keep on telling you guys. If we are trading patterns, you will be flawed a lot. But the reason behind an uptrend is not the same reason behind a downtrend. So MBM traders will focus on the reasons, the logic, the why. We don't care about what's happening now. Let me buttress what I'm trying to say to you guys here. You see, let's start from here. Let's just pick a random portion out of this uptrend. So I'm going to pick this level out. You see, from this high, yeah, to this low, back to that high. Sorry. So I'm picking this move, this down move and this up move, these two moves, I'm picking them. So I'm going to draw them out of the map out. I'm just going to put them somewhere here. So as we can see, yeah, this is it. So this one is shorter, then this one is longer, and that's it there. Now I'm going to come to the downtrend, and I'm going to do the same thing. I'm going to pick up. You see here, what did I do? I first of all picked up a bearish move, then a bullish move, right? The same thing I did here is what I'll do here. Now let me pick a bullish move first, then a bearish move. See that? Bearish move first, bearish move here, bullish move, bullish move. So I'm going to draw that out too. I think, yeah, that's it. So the same thing here is what I brought out here. Now, if I had asked you to close your eyes before I picked out these two things, yeah, and then I say, oh yeah, open your eyes, and I say, and then I ask you that, you see these two things, these two move here, what are the difference? The only difference you would say is that, yeah, this one bearish move is shorter than this one bullish move and all. But aside that, it is still the same thing. The point is that for every sell move, every sell move, every bearish move in the market, yeah, it doesn't matter the trend, it is the same reason. Every sell, every sell is because askers are becoming aggressive, and every buy move is because bidders are becoming aggressive. Remember when I taught you about the aggressive and the rest and others. Don't worry, we are picking up understanding. So when you see price come down here, when you see price sell, a bearish move here, either in an uptrend or in a downtrend, it is the same thing. It is the same thing. This one was picked from a downtrend. This one was picked from an uptrend. The same thing. The same thing for a bullish move. When you see a bullish move like this, it is the same reason, the same thing. However, the the thing that you call trend, because in MBM we don't do trend, we only follow price. But if you don't understand, if you don't, you see, I'm saying this on purpose because majority of you, that is what you started with. That's what you started with before you got introduced to MBM. These are the jargons you've been trading. So I'm trying to help you see the flaws in those things and come into a, a body of knowledge that is superior and guarantees results. I hope you guys get what I'm saying. Yeah. So it doesn't matter. Now that I've been able to help you understand that it doesn't matter, you see, so the reason why this price go up here is the same reason why price went up here. Okay, so regardless what trend. Now the question is, if it's that way, is market not supposed to be moving just one way, one manner? Now this is where the reasons now come into play. You see, when you see price continues to move in a certain direction, either up or down, there is a reason behind it. You don't just say, oh, this is an uptrend. Ask whoever told you it's an uptrend, ask him why is it an uptrend. They will tell you it's because it's forming higher highs and higher lows and all those. Those are jargons. That's just what's it called now? That's just pattern. Of course, we know this is higher high and higher low. What is making that higher high? What is causing it? So that I can know the next point where the higher low will be formed. They can't answer that. It is your understanding of something that gives you dominion over it. If you don't understand it, then why will you not be taking unnecessary stop losses? So I'm trying to help you understand it now. So now the question is, Max, good, you have explained to us that okay, it's the same thing, there is no difference. A bearish move here is the same bearish move here, a bullish move here is the same bullish move here. The only difference is the size and all. Now the question is, why does the size differs and why does price move in a certain direction for a while that people now start calling it an uptrend? Now, let me bring your attention to something before I answer that question. Do you know that trend is relative? That thing you call trend is relative. You see, this whole move here that you are seeing here might actually be a move on the 5 minute candle. But when you go to 1 hour candle, it might just be on the 1 hour time frame. Sorry, on the 5 minutes time frame, this whole thing you are seeing here might just be on the 5 minute time frame. But when you go to the 4 hour candle, what you'll be seeing is just one candle. This whole move from this place to this place will just be one candle. So trend is relative. So how do we know the trend to follow? Because you cannot tell me, and you see, traders would find excuse for everything. They will now tell you, go to higher time frame, do top-down analysis. MBM traders, we don't do top-down analysis. We don't do that. We do top-down, but not that way. Not that way. You need to understand these things. So if this trend here is only showing on the 5 minute time frame, then how are we sure that that is the major trend? That is the trend that is what we should be following? Because at the end of the day, this might just be, you see, this whole move here, this whole down move here might be a whole trend on its own if you even go to lower time frame, maybe like 1 minute or even 30 seconds. And the more you remember, I've taught you guys about the fractals of market. So the fractality of the market puts traders at a strong disadvantage. It disturbs them a lot. It stops them from doing a lot of things. And this is what the market business model is here to correct. Market business model tries to bring what's the word for it? Is it harmony now? It tries to make everything the same. It puts everything in one. So that by the time you are making market decision, you don't need to go and check here, confirm here, confluence here, that one, there. No, you just have a proper understanding of what the market is intending to do, and you follow. That's what the market business model does. Hope you get. Good. Now, for us to understand this, why price would move in a certain direction for a while, we need to now go back to our explanation of liquidity, volume, and volatility. You see, the first thing that comes into a market is liquidity. Without liquidity, there can never be volume or volatility. So in hierarchy, liquidity is first. Liquidity is like, let me explain something to you guys. Good. Let me use this explanation for you guys. If you open a bank account, for example, now, this is your bank account. Let's imagine you just created this bank account. It will be empty, right? Exactly. So you can say, I'm not liquid. I don't have money in my account. It's empty. The point is it's empty, right? It's empty. That's the point. Even if you have used the account before, but the amount is $0.0000 or naira, it's empty. So you're not liquid. You don't have money. But the moment liquidity comes, money comes into this bank account, then you can make transactions. Right? Exactly. That is the same thing in this market. The first thing that comes into a market is liquidity. So every candle, every time frame, every daily candle, 4-hour candle, hourly candle, weekly candle, or whatever candle, they are able to form because there is liquidity. So the first thing that comes into this market is liquidity. Now, when you deposit money into your bank account, you can actually withdraw it or transfer it, abi? Exactly. That is why when liquidity can actually come into this market and leave this market. I hope you guys are getting. Now, the interesting thing is that liquidity cannot be seen. I don't know if there are places in the world or establishments or organizations that have the sophisticated tools to be able to say liquidities in the market. Now, when I say liquidity, in your bank account, in the explanation of this bank account that I'm using, your liquidity is money, abi? Exactly, the money you deposit. But in this market, the liquidity is actually orders. ORDERS, orders. So money comes into this market through orders. In your bank account, money comes into your bank account through deposit, right? So you have to deposit. Either somebody transfer to you or you make a deposit. But in this market, you don't make deposits, you place orders. So liquidity in this market comes in form of orders that are placed. You place orders, the other person places orders. Somebody in Asia is placing a buy order, another person in the Philippines is placing a sell order, another person is placing a stop order, another person is placing a limit order. The point is orders come into this. So I don't know if there are organizations that have the tools to be able to see all these orders, because the point is these orders are much. There are much. Remember the explanation of liquidity I gave to you guys. How easily a currency can be converted. That was what I gave to you guys. I'm sorry, a currency can be sold, yeah, and converted to. So in this market, liquidity is the first thing. Just like your bank account, money must come in, liquidity. Orders must come into this market. Now, these orders, yeah, are being put into this market by only two participants, the bidders and the askers. So the bidders are bidding, the askers are asking. So for the bidders, they have their own type of orders. They have limit orders, they have market orders, they have stop orders. The same thing for the askers. They have limit orders, market orders, stop orders. The unfortunate thing about this market is that the market won't show you. In fact, I'm not sure anybody can know, okay, this is for seller, this is for bidders, buyers. Okay, nobody can say, okay, there is 1 million worth of orders to sell AUD and 100 worth of orders to buy US. No, I've never seen anybody say something like that. But these orders come into this market. We can't see them. But they are everywhere. We don't know. So what we don't know, let's not worry ourselves about it. Let's focus on, there are ways that you can actually, maneuver your way around it. And that's why you are learning MBM. I'm trying to help us understand this thing so that we can build understanding for what's to come. You cannot understand, if you say this is boring or this is long talk or whatever, that's how I teach my students. If you're going to be my student, you should be ready to know. Don't expect me to come here and say, oh, because of this one I fall now, it's because of sellers are in control. That's everybody knows that. Why are they in control? What makes them want to take control? Let's be logical, let's be sensible, let's be reasonable, let's speak. Okay, so I'm trying to explain. Now, these orders are already in this market in form of, the two participants, bidders and askers, have already placed. So they place orders at different price points. And remember when I was explaining, this thing to you, market participant, I said the fact that a price is cheap to you, that same price that is cheap to you might be expensive to another person, right? And the price that you say is expensive, because it's expensive to you, does not mean it is expensive to everybody. So while you are willing to sell here, somebody is willing to buy at that same spot. So why bidders are bidding, right? Askers are asking. And why you would think that because price is currently at this level, it means that it will continue to go up. That's a lie. Because the fact that price is at this point means that there was liquidity at this spot that have, price have been paired, P-A-I-R-I-R-E-D, paired. So it has been merged. Once those liquidity have been merged, definitely what do you think will happen next? There will be liquidity below. There'll be liquidity below. Remember, what is cheap to you, it's not cheap to. So why you think, some people will say, oh, this high spot here is too cheap, I want to buy at a lower price. So what do they do? They'll start placing limit orders at, below the price, below current price. And what will happen is that price will now come and touch into those limit orders and then continue going up. Now, why would it continue going up despite pairing all these orders? Sometimes it will pair all the orders, sometimes not pair all the orders. But why would it continue to go up? And why would it not pair all the orders? Now, this is where volume and volatility now comes into play. Because liquidity is in the market does not mean that liquidity will remain in the market. Because money is in your account does not mean that the money will remain in that account. Some of you, the moment 5,000 naira enter your account like this, sharp, sharp, you have moved the money. Exactly. It happens in this market too. Some people don't deposit into this market to trade. They don't place orders to trade. Some people don't place orders to make profit. Some banks don't need your profit. Government don't need your profit. The profit. There are a lot of, I explain it in the MBM in our starting classes, the kind of participants, and I try to let you guys understand government, central bank organization. They don't do these things for profit purpose. So the selling to them, they have other motives. That's what I'm saying. So the same way 5K can enter your account and you move it out is the same way others can come into this market and others can actually be withdrawn. Okay, for those of you who have been trading, you know that when you place a buy, a limit order, or a stop order above price or limit order below price, yeah, you at sometimes you close that order, right? Sometimes you close it exactly. When you place that order, it is recorded that there is liquidity. What you have done now is you have put liquidity into the market. It is now resting liquidity because it's not activated yet. It's in the market. So when you place one lot size, buy gold at so price, now what you have done is you have input liquidity into the market. That's what you've done. Just that market has not, that your order has not been matched, it has not been touched. You want to buy, there's no seller at that point yet. These are the things you need to understand. So at the same time, as that same order that you have put into the market, you can actually close it and say, look, I don't feel good about this trade again. I'm out. Or maybe you go to Twitter and you see one of the influencers selling gold and you be like, wow, I'm going to close this trade. So that liquidity is out of the market. Now, if you can do that, definitely that other market participants can do that. And this is where volume now comes into play. You see, if I want to explain volume to you now. If the same 5K enters your account, and then you send that 5K to somebody's account, and the person sends 5K back to you, the same 5K sends it back to you, your credit side will show how much? 10,000. That means you'll be credited 10,000 and debited 5,000. Now you send 5K out again and the person sends 5K back to you, and you guys continue to send 5K, and you do it 10 times. That means on your credit side, 5 times 10, that's 50. Yeah. On your credit side will show how much? 50,000 naira or $50,000. That means, and on your debit side would show the same thing, 50,000, because what comes in went out. The point I'm trying to make is, doesn't even matter if it's debit or credit side. The point I'm trying to make is that it is still 5,000 naira that is your real liquidity, true liquidity. But you and the person have been sending and receiving and sending and receiving. So your account will be showing how much? 50,000 credited. But the true liquidity is just 5,000. You can't, if you have not spent, you have only transferred. Do you get what I'm saying? You have not spent that 5,000. You only transfer it here, send it back. And by the end of the day, the volume of transaction is 50,000. So most people mistake liquidity for volume. Liquidity is that 5K. Volume is the transaction that 5K have made. So if out of that 5K, you were able to send, out of that 5K, you were able to send 100 naira back, 100 naira, 100, and you did it 5 times, your volume will show 5,500. You did it 5 times here, 5,500. They would think, someone who does not understand accounting would think that's the amount you have in your account. I hope you get what I'm saying. So true liquidity versus volume, and this is where most trader gets it wrong. Now, you see, when I was teaching you guys inflow and outflow, hmm, I did not teach you that it is not every sell move that is caused by outflow and every buy move that is caused by inflow. I hope you guys get. Remember, what we are doing in this market is what? We are exchanging. We are exchanging currencies for another. So sometimes those moves are caused by exchange, not really selling. Anyway, we'll get to that point. Now, you see, volume now comes into this market based on the interaction between buyers and sellers. So let's say sellers comes in with $10,000 and buyers comes in with $10,000 and they place their orders. Then sellers does not have up to that $10,000 to buy, but they are able to, still, you know, sell. Sorry, they don't have up to that 10,000. Buyers are bidding, right? So they are bidding for $10,000, but sellers don't have up to that. They don't have up to that. So what happened is that sellers would get into what they have, right? They will purchase what they have. And then what will happen is that whatever they have, uh, the buyers would have to take it. Whatever the askers have to sell, the buyers will have to take it. And then they put in more liquidity. Now, this is where volatility now comes. So that's what creates volume. Transactions. The moment both buyers and sellers are paired, transactions become registered. So buyers wants to buy 10,000, sellers are buying only 1,000. What will be sellers are selling only 1,000. What will be recorded is that 1,000 and it will cause a move. But at the end of the day, buyers still have pending orders to buy. So what do you think would be done there? They will have to close some of the orders here, some of the orders that they have put here, they will have to close them and then have to purchase, at the current price of the sellers. So this is basically what is happening. So buyers comes with 10,000, right? And sellers don't have up to 10,000, maybe just 2,000. So now what they do is that they sell to the buyers. Now remember, once the bidders once the bidders orders are paid, right? So you want to buy, and then let's say for example you want to buy, the bidders wants to buy. The moment they get what they want, let's say $2,000, right, worth of currency, that's what they want. The moment they get it, for them to make profit, they must sell it. So the bidders now become what? Askers. And what will they sell? What do you think they will sell? Is it $10,000 worth of currency? No. It's that same $2,000 that they purchase. So there we have to sell. And who is buying from there? The previous askers, those who were asking before, those who sold to them initially, plus new people who are willing, those who sold to them initially, who are now willing to buy, plus new participants who want to purchase. So what happens now is that the same money plus a little money, will be in circulation, and then it will cause price to move. The same thing happens, right? The same money in circulation. In fact, the funny thing about this market is that it could be the same money in circulation. No plus, no minus. I hope you guys get it. I hope this explanation does not burst your brain. But if don't worry, in our next class, I will give us a solution for you to have interaction with me so that we can explain this. But this is a YouTube class. I'm watching time and I don't want to overspend. So the point I'm trying to say here in essence is that volume now becomes money in circulation. This is the reason why you see that price would not come down to clear all the move. You understand? It will just come down a little bit again because now askers don't have up to that amount, and then then they just get what they want. And then this is why sometimes you see consolidation. They become war. They're matching the orders, trying to look and then before you know it, a big move just come into those market. Now you see those big moves you used to see it where price would go up, it is not caused by volume. Those impulsive moves are not caused by volume. They are now caused by what? By liquidity now coming into the market. See, if new liquidity don't come or leave the market, yeah. See, you see, is either liquidity, sorry, the impulsive move that now follow the whole consolidation can be two things. Either money, large liquidity is leaving the market, or large liquidity is coming into the market. Now we can't know that, but it will be definitely be both of them. Now, if the same liquidity in the market is what is being passed from buyers to sellers, bidders to askers, price would eternally continue to move that way, move in that same way. So the more there is plus or minus, then we can see price move. So if there is more outflow of, let's say, USD, that means, now let's say this is the chart of AUD USD, right? So if there is more outflow of USD, then definitely we'll see a bullish move. And if there is more inflow of AUD, we'll also see a bullish move. And for bearish move, an impulsive bearish move, which is volatile bearish move, it means there is massive inflow of USD or massive outflow of AUD. Now we can't know which is which. I wish we can, but we can't know. Right? Now there is a way we can also know, but it's not covered in this teaching. Okay? I'm not telling you guys those ones. Those are for my students. Okay. Now, I wanted to say, yeah, exactly. Now you see this move, this particular impulsive move. This is where the volatility now comes into play. Okay, this is where the volatility now comes into play. So you see, volatility comes that because of the minus or the plus of liquidity. Okay, and then you see price move that way. So when you see a sell trend, this is basically what happens inside that trend. So every bullish move in a sell trend still follows the principle of this thing, what I explained to you. You just flip the script. How do you flip the script? You just say, in a sell trend, you see sellers with their aggressively asking, askers aggressively buying, askers aggressively selling, and bidders, sorry, askers as aggressively, asking, and bidders, what am I saying? Askers are actually asking, while bidders are aggressively filling the orders. You understand? So the bidders are the aggressive ones now. And then when it gets to a point when there is exhaustion, then you see much, ask others will be, sorry, let me make it interesting. So you see where limit orders, and don't forget that these are limit orders. There are also pending orders, stop orders below price that price still needs to come and touch. The same thing here when I was explaining this one. So apart from the limit orders here, there are still some orders above. I hope you get. So the moment the sellers, the buyers have already, what's it called now, do what they want to do, then there are sell orders, and then the buyers try to buy in, bid, and they are bidding and bidding, and price gets to this point, and they couldn't fill up all the liquidities that the askers are bringing to the table. What happened? The askers, and then they come and join all of these stop orders. You understand? So, and then price continue that way. So just flip it that way. You get? So basically that's how price move. Okay, so the same reason why price will buy here. Why is price buying here? Because of bidders. Why is price buying here? Because of bidders. Why is it selling here? Because of askers. Why is it selling here? Because of askers. Either in a sell trend or in a bullish trend. Now, I'm going to explain something to you guys, right? And this is where I'm going to close the class, and we're going to continue in MBM 026. Now that you understand all of these things that I've explained to you guys, right? How do I say this now? How do I say this now? How do I say it? Okay, now that you have this understanding, this knowledge that I've given to you now, it is now high time for you to now use them to now understand price direction. See, if you don't understand these things, you cannot know what market wants. See, let me even show you stuff. Before you say I'm speaking to. Look at it here. You guys will say, oh, this is a bullish trend. Then what is this? This is a bearish trend bar. But then you can still say from here to this here, it's still a bullish trend. But what of the bearish trend? Does it not just cancel the whole bullish intention? It does. So you need to understand all these things. So knowledge is important. So by the time in MBM motuses, what the point is, I'm trying to help us understand anchor candle number one, and secondly, so that by the time price starts going up, you are not, you with precision, you can tell that okay, you see this price that is coming down here. When it gets to this spot, it will reverse a little bit. And this reversal here is not, this whole move here is not a reversal that price wants to reverse up. No, this is just a pullback, as you guys will call it. So that you can see when price move in certain way, you are not surprised. You can be able to say, okay, this is a pullback. Because for some of you now, because of price already starts moving up, yeah, you would think it's a reversal. It's not. You need to understand this. Understand reversals, how reversals works, and how pullbacks and correctional phase happens. I hope you guys get what I'm saying. So that's the idea behind the whole teaching that I'm teaching you guys. Okay, exactly. So I think that will be all for tonight, guys. This is almost this 57 minutes already. So that will be all for tonight. We'll proceed in our teachings little by little, brick by brick. A house is built, guys. I'm not in a hurry. If you're in a hurry, then MBM is not for you. This is a new concept. This is something that some of you have never had. So it just makes sense that you relax your brain and you study, you learn as I'm teaching you. Okay. So aside from that, I think we're good for tonight. Till we meet again in our next class. Do have a wonderful night rest. Okay.